Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I am going to show you why I am not a day trader. Now, all has been pretty quiet for me in my positions in my account. I am just patiently waiting for my call option to expire this Friday. This is the call option that I'm talking about. It's a $35 call and it expires this Friday, and you can see the bid right there is $6. The ask is $7. And if we look at when I sold it, let's go ahead and go to my transactions. There it is right there. I got $30 for that. That was $38 minus commission, and that was back on the 16th. Today is the 27th of November 2018, and this call option expires today's Tuesday, so in another 3 days on Friday. And you saw it's already down to $6. I could already buy it back right now for a profit, but I like to collect all the premium that I possibly can, and I'm going to wait for it to go down to zero, and I'm going to buy it back for $1 or $2, and then I am going to sell some more calls, and I'm probably going to sell to open a put, and I'm going to show you why. Now, let's take a look at what's been happening with Twitter here. Okay, so I'm going to go to my chart, and we're going to look at Twitter. Let me clear this out. And right here, Twitter was pretty range bound, and then here's where all the fun started, right? This is when the market started selling off. The tech stocks have been getting a beat down, and Twitter stayed resilient. It went up and then it went down. And so back here, Twitter was at the $35 level, and I was getting pretty decent premium for those strikes. And now I want to show you, if you watched my last video, I made a prediction. I predicted Twitter would go below $31 in the next few days, and that was a few days ago, and Twitter did not do that, and I'm going to show you what happened here. So let me zoom in this part right here, and there you go right there. Now, the reason why I predicted Twitter was going to go down, let me get rid of this. The reason why I made a prediction is because Twitter started to formulate a pattern, right? Up and down and down and up and down. But then this happened, okay? Now, when this happened, that right there was a resistance. That was the support. And because it was making this pattern movement, I thought that it would continue to go down, because if we zoom it back out a little bit, it was making, Twitter has been doing a bear trend, right? It's been going down like this. So I felt that Twitter was just going to continue its bear trend, and it was going to go down there somewhere, but Twitter did not do that. So let me rezoom in back to that part right there. Oops, I messed that up. So let me try this again. There we go. And so right here, Twitter broke. And so whenever a stock does that, that means that this pattern has become invalid, and we can no longer trust this pattern. And it's stuff like this is the reason why I'm not a day trader. I just don't believe that you can learn 3 simple chart patterns and you're going to get rich. I don't believe that you can find an edge in a pattern, or in 3 patterns, or in any pattern. I don't believe edges exist in chart patterns. Chart patterns are a visual representation of the history of the price of a stock. And how many times have you seen commercials on TV that say past performance do not guarantee future results? Yet day traders and swing traders will tell you till they're blue in the face, oh no, you can find edges if you look for a head and shoulders, or if you look for a falling knife, and they have all these patterns that tell you, oh, I have an edge here, I have an edge here. I don't believe it, and that's the reason why I am not a day trader, and I have become an option trader, because with options do have an edge, and the edge is not because of chart patterns. The edge is mathematical, okay? I have a mathematical edge as an option trader, and I don't need to do any back testing to prove it. the numbers, the math prove itself. What is the edge of option? The edge that I have is called time and leverage. What do I mean by time? I mean that I can buy a call option that expires a year from now or 2 years from now, spend $800 or $900, and then I can sell to open weekly call options or put options, and I'm making $20 a week, $30 a week. And if you've been watching my videos, you know this is true. You know that I have been doing this on a week after week basis, right? So if I'm making $20 a week, $30 a week, I'm spending $800, $900 for a call, whatever. There's 52 weeks in a year. What is 50 times 20? That's $1,000. So within a year, I've paid for the option. And the leverage that I get buying and selling options, that's how I cut my losses. So options act as their own stop loss, and the time value, the weekly calls and puts, that's my income, and I do that week after week until Twitter or whatever stock that I'm buying my calls and puts makes its move, and then bammo kazammo, my account goes up. And so that's the reason why I'm not a day trader, because when I look at this, you know, I looked at a chart pattern, I made a prediction, and once again, I was proven wrong. My prediction did not come true. I am wrong about stocks on a regular basis, but somehow I continue to make money buying and selling options. Somehow my account continues to grow. Why is that? Because I have a mathematical edge. I don't need a pattern edge. I don't need to go back in history and look for chart patterns and say, aha, okay, well, shoot, this pattern right here showed this, so if I trade this pattern and I buy the stock down there, then bammo kazammo, I'm going to make some money and I'm going to sell right there. Who does that? I mean, if that nonsense was really true, wouldn't everybody be a day trader? Wouldn't everybody get rich doing this? But options are different. You don't need to back test options because mathematically you are given an edge. And so right now, let me go back to my Ameritrade account here, and let's go back to my positions here. So right now I am patiently waiting for this call option right here to go down to 0, and when it does, I am going to sell to open both a call and a put. And let me go back to the charts here, and I'm going to show you why that is. Okay, so full featured chart. Let me clear all of this out. No thanks on that ad. Let me clear all that out. Let me go back to the month. Okay, so this is a month, and the reason why I've decided to sell both a call and a put is because it is true, I do use patterns, I do use charts to help me make my decisions, right? But I know, because I am wrong on a regular basis, and I know that patterns are not crystal balls, that's why I buy and sell options. And the math is where my edge comes in. But I'm still going to use patterns to make my decisions. And the decision that I make is I am going to sell to open a call, and I'm also going to sell to open, I'm going to sell to open a $35 call, and that $35 call is up here, and I'm going to sell to open a $30 put, and that's down here, and I am going to wait until my option expires here in a few days. So when it goes back down to $1, let me clear all this out. I'm going to buy to close my $35 call, and then I'm going to sell to open another $35 call, and then I'm going to sell to open a $30 put, and that's based on this new pattern. So when this pattern right here got invalidated thanks to this nonsense, I don't go by that. Now I go by the next longest pattern, and that's all of this right here, right? So we got the low part there, we got the high part there, and up here is the safe level. On the upside down here is the safe level, that's the support. The top level is the resistance. So I'm going to sell to open the $35 call, I'm going to sell to open the $30 put. Now let's take a look at how much money that I'm going to get. So here in 2 or 3 days, this call right here is going to go to 0. I'm going to buy it back for $1 or maybe $2. And let's take a look at the option chain on Twitter. So let's go ahead, and here it is right here, and let me put out of the money, and let's take a look at what I'm going to get. So here is the $35 call. So it looks like the bid is 29, the ask is 30. that amount of money right there already is enough money for me. I could just sell the call and I would be doing fine. So 29, let's say I get, minus commission, $23 for another week. That would be more than enough money to pay for my calls and my puts. But I am a little bit greedy and I'm going to do both. And here's the $30 put, and the bid is 23, the ask is 25, so let's say 24. And all this is going to change in a few hours because the market opens in about 3 hours. I'm doing this in the middle of the night. My day job is really a night job. I work nights, and so when the market opens, all this is going to change. But as it stands right now, the bid is 23, the ask is 25, so I'd probably get 24 minus commission and bring me in $18. So $18 for that, $23 for that, so that's about $40 that I'm going to be making for another week. And it would be very safe, because if Twitter goes below 30, I start rolling it down. If Twitter goes above 35, I start rolling it up. Oops, that was a mistake. Let me go back there. There we go. And bring this back up. Apologize for that mouse click error. So if Twitter goes above 35, then I start rolling up, or I have been wanting to sell to close my $30 call option that expires in January of 2020, because I am up on that position. I am up on that long calls. And by the way, just for a snapshot of how am I doing, today is the 27th. It's exactly 1 month and 1 day since I bought to open this put option, this $32 put option. So this is my call. My $30 call expires in 2020, and this is my $32 put option, expires in 2021. I bought this on the 26th of last month, and so now it's the 27th, 1 month later. And let's take a look at how I'm doing. Okay, so let's go to my transactions, and let's go to October the 26th. We'll put it about a day ahead of time, put 24th like that, and so there it is right there. That's my $32 put. I spent $767. This call option I bought to close. It was a weekly call that I sold, and this was the week before earnings, so I got a lot of money for it. And when the smoke cleared, I made $40 in premium selling calls, but my call was up big. But don't mean to digress, back to my put here. So this put I bought on the 26th, and since then I have been selling weekly calls. So on the 30th I sold this call for $35.50, and I got 20 bucks for it, bought it back for $1, and then that was on the 2nd, a few days later, and then I sold another one, got a nice $48.29, sold a $35.50, bought it back for $4, so made $44 profit. Then I sold a call and a put, and so this call expired on the 16th, the put expired on the 23rd, so I made $40 for that, $20 for that. Here's the dollar that I spent to buy back that 41, so I made 40 bucks on that. And the put down here, I bought it back for $1, so let's add all this up: 20, 68, 109, 130, 160. And then let's subtract the red numbers: 160, 59, 155, 154. So let's round it down to 150. I made about $150 in my first month on this strangle. And when you look at this, whenever you buy a call and you simultaneously buy a put, that's called a strangle. And the reason why you buy a call and a put is because you believe that the stock is going to go up or down. You don't know which way, and I certainly as heck don't know which way, but I do believe that Twitter is going to go up or is going to go down. I do not believe Twitter is going to stay flat, dead in the water, not move. I think that Twitter is a volatile stock, and so buying calls and buying puts simultaneously is a very good idea. And so again, I made $150 selling weekly calls. Now let's, again, mathematical edge. Let's look at the transaction. Let's look at my total investment. So let's go to transaction. Let's go to September the 10th. That's when this party all got started. So I spent $777 for that call, and then I spent $767 for this one. So that's like $1,530. So let's just say $1,550 that I spent. Well, I'm making $150 a month so far. If I continue to make $150 a month, in 15 months, I'll make $1,500. So I'll basically have all of this paid off. And that's not counting the fact that this is a $30 call, and this put is a $32 put. So I have a $200 cushion. So I'll actually be up $200 on the whole thing because of that gap between the $32 strike price and the $30 strike price on the call, right? But I'm not a day trader. The reason why I talk about options so much is because I'm pretty terrible at predicting stocks. I get it wrong on a regular basis, but the numbers, the mathematical edge that I have as an option trader overcomes all of that lack of ability that I have to be a day trader. I do believe that it's possible that you can do something like that, but it's never been in the cards for me. Who knows, maybe someday I'll figure it out. I'll learn the secret chart patterns and I'll get rich. But in the meantime, I'm going to stick to my options. I'm going to buy calls, I'm going to buy puts, and I'm going to buy leap calls, leap puts. I'm going to sell weekly calls and weekly puts, and the mathematical edge that I have as an option trader will overcome my deficiency in all the other areas of investing. So thank you for watching this video. I hope you enjoyed it. As always, if you have any questions or comments, feel free to leave a comment in the comment section, and we'll see what happens in a few hours when the market opens. Have a good day.